Well, good evening, everybody. It's Blair Nightingale here. We're back. I told you we'd be back. I told you last week. We're here every single Monday night, 6 p.m., kicking off the week for Tradeway TV. We've got programming for you Monday, Tuesday, Wednesday, Thursday through the week. Some in the afternoon, some in the evening. Our schedule's posted right there. YouTube, Tradeway TV. You can always check that out. Of course, we've got friends here. You are joining us from YouTube, but also on Facebook. Appreciate having you guys here. As always, it's such an amazing opportunity for us to use this technology, which is normal now. But I can remember a long time ago, I wanted to do things like this, and we've still got ideas that we'll have coming in the future where we're able to connect with traders, investors, people out there in a real simple format. And we get to do it right here. It's so normal now. So it's amazing. Thank you guys for being on here. Some of you guys have been with us many times. Some of you maybe have not been with us at all yet. My name, as I said, is Blair Nightingale. We come on here on Market Monday to get exposure to the mindset and the skill set of a trader. Now, one of the things we're going to talk about in our headline tonight is keeping up with the headlines. I want to talk about news. Most people that I meet that have any interest whatsoever in the stock market, it may just be because they're building retirement. They have an IRA. More commonly, they just have a 401k, 403b, some kind of an employer retirement program. Over 66% of Americans are in that are of working age are in the stock market already through retirement programs. So it's something that whether we know a lot about it or not, many of us, right, most of us technically are connected to in some way. If we even go a step further and we're interested in actually learning how the markets work, the number one thing people tend to gravitate towards is the news. It's the news and using the news to inform us about our investment decisions. And tonight, what I want to do is talk through that. Should I use the news to inform my buying and selling decisions? If so, what news? Is it all useful? Is some of it useful? What's the difference, right? I want to make this really simple for you. Last week, we went through looking forward in this year. If we go into a recession, whether it's as Fed Chair Powell says it's going to be a light one or it ends up being heavier, I gave you a few things that I think you should watch for the longer term, meaning the next year or more, right? For a trader, a trading mindset, that is long term. Okay. For an investor, a year, it's not that long. But for a trader, that is thinking long term. So I wanted to give you a couple of things to think through to put yourself out of a position of fear and an expectation of loss into a position of expectation of opportunity. So even that conversation had news in it. Okay. But we have to make a differentiation between investor and trader. Investor, long-term. Trader, short-term. Okay. The more I move from investor to trader on the spectrum, the more I move away from a company's fundamentals and the way I look at news. I move away from a company's fundamentals to the technicals, which is the definition that investors and traders use, Wall Street uses for price. I show you guys from time to time right here on the screen. I show you the chart, right? It's a stock chart. You can pull up stock charts on the internet just like that now, right? So easy to do. We have incredible tools and price information, and it helps us be traders. We don't need that quite so much when we're investors. It's not that it's not useful at all, but it's not as useful because we're looking at the long-term health of a company. When we're going to buy and we're going to invest and we're going to stay with it for the long haul. When we're trading, which most folks that are in our programs and in our communities are learning to do both. We want to encourage people to have long-term investments, even if we do teach them to have a more active perspective on that than, say, your mutual fund manager who just leaves it in, right? I was looking earlier today at the largest actively managed mutual fund in the United States. It's down over 40%, right? The S&P isn't even half that right now, right? So we want to do better than that, even in our long-term money, but we're also learning how to do that short-term. And for the trading side, news takes on a different relationship with us. So what I'm going to do, I'm not going to keep this long. It doesn't need to be. In fact, there's an old saying that says, if you spend 15 minutes reading financial news, you've wasted 12 minutes. Now, I'm sure, like a bad game of telephone, that quote has changed a little bit over time. But the point is potently clear, right? Most of the time that we could spend reading financial news is not necessarily the amount of time we should spend. Why is this important to you and me? Because A, it wastes time. B, we look to make buying and selling decisions based on news, and news does not help us be successful as traders when we're buying and selling based on the news. Okay? It does not give us an idea of how to manage risk as a trader when we're actually buying and selling. If I could tell you how many times as a coach I get questions, hey Blair, I heard this stock, this company has got this new product. They've got a new leader. They're cutting costs. They did some layoffs, whatever it might be. It's news related. Should I go out and buy that stock? Okay. Or should I go and sell that stock? And on average, I'm going to say no. Now, there may be an opportunity in that stock that I perceive for another reason as a trader, okay? But based purely on the news, no. By the time you and I get the news, it's already priced in, save for a few events, which I'm going to tell you what they are tonight. There are some exceptions. But most of the time, that stuff's priced in, right? We're not getting it as fast as Wall Street's really getting it. They're coming through financial news outlets. I see things happen in front of my eyes on the chart in real time, way faster than I ever get a CNBC alert on my phone. I get the CNBC alert, but I watch the price in real time, right? I can make decisions there way faster than I'm going to make decisions through what goes through CNBC. People who don't know how to do that listen to the news. They listen to Jim Cramer. And I'm not attacking anybody, but I'm saying if we're just buying on news, it actually doesn't help us, right? It doesn't help us. And I would also say we don't know how the news is going to affect a stock ahead of time. Sometimes people speculate, oh, I'm going to go and I'm going to buy this stock because I perceive this news to be good, right? And then the market actually interprets it differently, right? Sometimes in the market, good news is bad news. Right now, sometimes when we get strong financial data in the markets, then it puts downward pressure. Why? Because if our economy is strengthening, Wall Street speculates that the Fed is going to go, oh, okay, wait, our economy is still growing. Why? Because we had good data. Well, we don't want that. Why not? Because if it's still growing, inflation's going to get worse and they're going to raise rates. It all gets confusing, right? Because now a good thing is a bad thing. And sometimes a bad thing is a good thing. Oh, really terrible financial news came out, right? We got terrible data. Well, that means that the banks failed. We talked about that last month. Some of the banks failed. Oh, well, maybe this is actually going to mean that the Fed stops raising rates. Once Wall Street got over the initial panic of the banks failing, they started getting hope and buying stocks because they thought this may mean the Fed stops raising rates. See, it just gets confusing. It's not objective. It's very subjective, very subjective. So the news doesn't really help us do that. So I want to give you some things to grab onto that are going to help you navigate this. Because A, you don't have to spend time really reading the news other than scanning for a few key items, which I'm going to give you now. Because when I open up the markets every morning and I start interacting with students, I do read financial news every morning, but I literally read for about 90 seconds, maybe 2 minutes. If there's a huge news item going on that may be driving action in the market in some way, or it's a volatile day, then I'll maybe take another minute and read about that. But primarily, that doesn't happen. And if I do read about it, it's something that we anticipated being a news item anyway. Doesn't mean we knew exactly what the market was going to do, but it was probably one of these main news items I'm going to give you because it doesn't tend to change very often. Remember that Wall Street and financial media is a major industry. They just keep putting out articles. Okay. I'm not saying that there's no value in any of those articles either, but we want to sift through it because it's a business and it's just cranking out content. And we don't need to read all of it. It's not useful for you and me. The price as a trader is way more useful than the news. Okay, but what are some of those things that I do need to pay attention to? We pay attention to what we call market tone. Okay, market tone. If you could picture market tone as the psychological tone of the market, is it more positive? Is it more negative? Right? I don't want to buy when the market is really negative. Okay. And if it's really positive, then I want to know that too. I want to be looking for opportunities. But how do you really know? Well, number one, we're going to look at the chart of the S&P 500. What is the market actually doing? They can say all kinds of things in the news, but what is the market actually doing? And as I mentioned earlier, what am I seeing in real time? Right? I can watch charts in real time now, whereas the news is very slow compared to what I'll see on a price chart. But that's only a part of market tone. Okay. We have to give some space for the news, not too much, but some space to the news for market tone because it can impact what happens on the chart. It's just that we narrow it down to a few things. So I would say a little bit, about half or a little bit more of market tone is really the S&P 500. But then we've got one, maybe two main news items that are driving price action in the indexes. We can get down to one main news item that's maybe driving Apple or it's driving ExxonMobil, right? There are stories that we can get into as we drill down. But looking at the index as a whole, the market as a whole, really right now, it's Fed. It's Fed. If it's more than that, it's because it's related to Fed in some way. And when Fed comes and goes in terms of being the obsession of the market, because the Fed is the obsession of the market right now, when we're in low rate times, right, where the Fed is able to raise or lower interest rates, we were at zero or near zero for a long time. It's not that a Fed meeting never came up or that traders didn't know about it, but it wasn't nearly as big of a deal. And once the meeting passed, we just kind of forgot about it and moved on, right? Earnings seasons would come and go, things like that. But the Fed wasn't such a big deal all the time. But right now, it is. That's one. That's one to watch all the time. Fed is a big deal. Earnings season right now. We're in earnings right now. 4 times a year, every publicly traded company has to publicly report their corporate earnings to the public. This is what we call earnings season. When you get into a new quarter and companies begin to report, this is how we did last quarter. Wall Street has all kinds of analysts, and the analysts will have a prediction that they believe Google, Meta, I was going to say Facebook. Facebook is Meta. Netflix, Apple, Microsoft is tomorrow. That's a big one, right? They'll give these projections, and then it's up to Wall Street just to watch and see, did that company beat those projections or not? Now, I got a whole thing to say about how that whole system works because it feels like a little bit of a racket to me. But, did a company really do well if they lowered the expectation to the floor? The old saying, you can't fall off the floor. Oh, wow, Microsoft beat on expectations, but they lowered the expectations so low. Was it really a beat? 75% of companies on Wall Street that have reported earnings in this earnings season have beat estimates, but overall earnings will drop 5% from last quarter, which means overall we're headed down, even though 75% of companies beat their estimates. Okay. Which number really matters? It just starts to get crazy. So overall, for you and me as traders, I just want to know, am I going to buy a stock that has an earnings report, right, during the play that I am attempting to do? Period. That's it. Do they have earnings during the play that I'm trying to do? If they do, I'm not doing the trade, or I'm going to exit the trade prior to the earnings report, preferably prior even to the day prior to the earnings report. So at least 2 days before. Things start to get more volatile as you get closer. Fed is huge, right? We talk about CPI. That's the Consumer Price Index, which is a fancy way of saying inflation. What's the number? What's the percentage of inflation? That's CPI. It comes out and we get a reading that is closely tied with the Fed, right? If CPI keeps going up, you and me, we're going to spend more money at the grocery store, at the gas pump, on everything. Then the Fed's going to have to try to deal with that. And that's what Wall Street does not want them to do. That's a main story. You can keep your eyes on that one. When there's major news in that area, that's something to pay attention to as a trader. But remember, even when the Fed passes away, it's going to become something else. And that will be the one main item. We don't need to try to keep our hands on 100 different things in the news or go out and buy a bunch of financial memberships and read all the articles and things like that. We can learn some things out of that stuff. But again, primarily anything that's worth its salt in terms of information on a company is, first of all, going to lean more to the long-term buy and hold. Second of all, we still want to sift through it because a lot of it's just opinions, right? I usually tell you guys, when I'm giving you an opinion, opinions are fine, but they should be spoken as though that's what they are, because that's all they are. They are opinions. So if I give you one of my opinions, that's fine. You give me one of yours, but let's be real. This is an opinion, right? And there's all kinds of opinions from people who are writing articles in the news about stocks that they are invested in. Now, they have to tell you that, okay? But they may have an interest in that stock. Who knows what the driver there is, okay? So, Fed earnings on a stock. We're going to get out of the stock. And for those of you who are doing some of the strategies where we're looking to actually sell premium, you're using options, you're selling premium, just remember the way you do that. As you get into volatility, those option premiums are going to expand like a balloon when you get closer to earnings, for example. So you're going to be able to sell those options for more of a credit, okay? But as you get closer and closer and closer to that earnings report, that's going to expand even more. Okay. If you're looking to exit a play before the earnings report, even if you're using that kind of a strategy, you're probably going to end up paying more to get it back. Depends on what the stock price does, but you're going to pay more baseline to get that back than you got paid for selling it in the first place because the volatility is increasing. Okay. You would have to hold over the earnings report to see that volatility come back down to normal. This is just how options prices work. Okay, so we want to be cautious, and that's why we take time to really train on how those strategies work in our programs. Adam's got a question for us. I'm going to jump in, put this up on the screen right here. How do you know if a company lowering product prices is good or bad? Tesla is in the news for lowering the cost of their cars. Yeah. What I did see, and this was a CNBC alert that I got, was Tesla missing on revenue significantly. Right? They dropped significantly in the amount of money that they made. And this, I think, is what Wall Street is really watching for: is, are we really seeing contraction in companies, right? And how much? The Fed's been raising rates, right? They don't just sell when the Fed raises rates for no reason. They sell when the Fed raises rates because they anticipate that those higher rates are going to shrink the economy. And they don't want to invest in Wall Street in essentially a shrinking economy. They want to invest in an expanding economy. And when interest rates go up, they can take their money out of the stock market and deploy it in some other places that they feel is safer and more fitting for that kind of an environment. So they're seeing that happen with companies. Adam is letting us know, okay, this is something that's happening with Tesla. Now, specifically, Tesla making a move to lower product prices. Is it good or bad? This is a perfect example. This is a perfect example of what I was saying about questions where you go, okay, now I have to take this thing and I have to use the news to try and guess what the market, and I mean both the consumer market and the stock market, what are they going to do with that, right? What is this going to do to revenue projections for Tesla? Right? Well, we're going to make less on each car, but we anticipate selling more cars as a result of lowering the prices, right? It's going to be more, affordable to a mass audience. So we'll make less per car on these, but we'll sell more cars. Maybe that's what they're saying. Or, you know what? We're restructuring. We're going to take a hit for a little while, but in X amount of months, we're going to be in good shape, right? They might be saying that. You and I go, I don't know. Right? That's the thing. We think if I read enough news and I get enough info, I'm going to be equipped to know what the stock is going to do. Or I'm going to be equipped to know more likely, right? What's more likely for the stock and what it's going to do. And that's not necessarily true. It's just not true. Even as technical traders, we don't know what the stock is going to do, but the price doesn't lie. It tells us which way the market is moving. And all our job is as traders, it's not to know what the stock's going to do, news or no news. It's to manage our risk in an environment of momentum. That's our job, right? Our job is to manage risk in an environment of momentum, right? The poker player goes into the casino who knows how to count cards, or he's playing 21 or whatever, right? This is an honest statement. I've been to casinos. It's just not my thing, right? I don't like it. And I like it even less knowing what I know as a trader, right? I'd rather be able to use the stock market to manage my edge than anything like that. It's just, and it's, anyway, I have opinions about casinos. The point is that if he goes in, or she goes in for that matter, and understands how to count cards, which is what? Understanding how to read probabilities. They don't have a skill set that tells them what the next card is going to be, right? That would be some kind of prophetic gifting, right? They just know the probabilities of a hand, and they bet higher on high probability hands, and they bet lower, or they don't bet at all on low probability hands. And over time, they work the system. Now, the casino will kick them out because their skill set works so well, if somebody's good at it, that it shifts the favor to this individual. From who? Away from the casino. Not good for business. Won't let them do that. Wall Street will let us do that. They just expect that we won't have a skill set, and they expect that we won't be disciplined enough to use it. That's what they expect, right? So final thoughts on the question here Is it good or bad? We'll have to see. I don't know. I'll tell you what I'll do with Tesla. I'll go in and I'll watch for pattern and momentum in the stock. And if it forms a pattern with momentum that I can get a good risk return on, I can consider placing a trade on that stock. Otherwise, as a trader, remember, I made that differentiation. As a trader, doesn't matter to me. And that's the freedom we have. I'm only going to look at that one major news item and I'm going to forget the rest. I am going to pay attention to earnings on my stock. If I'm trading a specific stock, I'm going to pay attention to that. That's important because for the trader, and I want you to get this, if you're a note taker with me tonight, I want you to write this down. Nobody ever told me this as a trader. Okay? The reason traders, as opposed to investors, traders pay attention to the news at all is because news, it doesn't inform us of direction. Okay? It does not inform us of direction. It can imply a direction, but outside of that main news item, like Adam just helped us see, it's very subjective. Okay? It does not tell us direction. What it does is it tells us when there's a heightened expectation of volatility. News can give us a heightened expectation of volatility. So, example, let's say Thursday is the CPI report this week. It's not. In fact, I think Thursday is actually a GDP report, which is significant. It's significant. So let's just say that. All right, Thursday has a GDP report. Okay, Blair, is the GDP report going to make the market go up or is it going to make the market go down? Is Wall Street going to be upset if the GDP goes down? That means our economy is contracting. It's shrinking. Our productivity is going down. Are they going to be upset by that? Well, you'd think they would, right? Our economy is shrinking. That's not good. Well, wait a second, though. What if they are happy about it? What if that makes them think, well, the Fed's going to stop raising rates? Well, that's good. So then bad news becomes good news. Well, that's confusing. If you're confused right now, congratulations. That's what happens when we try to figure out all the news. And what's it going to do in the market, right? Now, maybe they think it's good. Maybe they think it's bad. Maybe GDP gets bigger and it beats their estimate. Is that good? Well, you'd think so. You'd think that would be good, but maybe that's going to make them think that the Fed is going to want to raise rates even more, and that would be bad. So it's like, wait a second. I don't know. Here's what I do know. Here's what you and I can know. Capital K, know, right? You can know that you and I should anticipate volatility around large news items because our job is not to know the future. I will, and I will continue to say this as many times as necessary because there's so much misunderstanding when I meet people around the country, so much misunderstanding about what trading actually is. So many people think trading is about using a skill set and somehow knowing what the stock market's going to do. And it's no wonder a lot of people doubt whether or not it's actually possible to stock trade, right? Or people think, oh, Blair, you're teaching gambling. And I always say on here, it's never guessing gambling or just going for it, okay? Why? Because I'm not trying to guess what the market's going to do. I'm managing risk. Manage the risk. Manage the risk. I went and saw a movie last night. It was Ben Affleck and Matt Damon's Air. It was the story of Nike in 1984 signing Michael Jordan to his first shoe deal, right? Actually, a pretty incredible story how the whole thing played out. But I won't give anything away except to say that the start of the movie shows one of the main characters going to Vegas. Now, he knows sports like the back of his hand, particularly basketball. He places a bet. He's just gambling. He places a bet on like 5 or 6 different things, and he wins a bunch of money. And then he takes that money and then he goes and he makes another bet, and he's not thinking risk management at all. He's just betting, and he wins big and he loses big, and he loses it all right at the start of the film. And I thought to myself, yeah, that's gambling. Boom, bust. There's no management of risk. You don't know what's going to happen. The gambler just goes for it. But the trader manages the risk, right? And when we know there's big news coming, we don't need to interpret what it's going to do to the market. We don't need to try to guess the direction. That won't work. What we can do is go, oh, there's a major news item coming. That's probably going to create a lot of volatility. I don't know if it's going to go up or down or not, but that does not help me as a trader manage my risk, right? I don't really want super high volatility. I want some volatility, right? It causes stock prices to move, but I don't want really high volatility. So, you know what? GDP, CPI, earnings report, those kinds of things, I'm just not going to trade. I'm not going to trade over that particular point in time. Or if I'm in a trade and I've got a nice profit, I'm happy to take it off the table or some of it. Remember, we don't have to. You buy 100 shares of something, you don't have to take 100 off the table, right? You could sell 80 shares and leave 20 on. And in that way, manage your risk. You can sell 3 contracts and keep 1 contract on the table, right? Depending on how your money management rules are applying to that particular position. But you are using news to recognize volatility. Most people try to use news to decipher direction. We don't want to try to decipher direction as much as we want to recognize volatility. Again, and this will be my closing thought, as a trader, this is important. When we move to the long-term buy and hold, right? The active investor, that's going to be an environment where some of that news will come into play a little bit more in some ways. In some ways, it won't. We will use some of that data, leadership, direction, layoffs, all this kind of stuff that can come into play for the longer term investor. And yet at the same time, some of it we're just going to ignore, because if you believe in a company over the long term, you aren't going to listen to every little thing that comes along and makes you think, well, should I get in or get out, right? We're actually just going to hold on to that. My parting thought tonight is, I was walking earlier this afternoon and I thought, and I haven't researched this yet. I haven't, but I'm going to look into it. And I'd encourage you to maybe even do a quick search and see what comes up. I don't know, it'd be very interesting. In what I've learned over these last 7 years, how much money would Americans saving for retirement make if they knew how to do some of the simple trading strategies that we teach people how to do, and they didn't really buy any mutual funds at all? They just bought indexes and ETFs, and that's it, and didn't even pay a financial advisor for it. Who's to say that that wouldn't be way better? Because the data on mutual funds versus the index over the last 20 years says that 95% of actively managed mutual funds don't beat the indexes. So why not just buy an ETF that tracks the index and get rid of the guy or the woman who's charging you fees to do what? Leave it in till the bottom? I met a financial advisor. I think I said this last week. I met him last week. And I said, what's to stop people from just going out and buying SPY? Right? And there are other index products other than just SPY, right? I'm not only trying to highlight that. And it's not a stock tip. I'm not pushing this specifically that we go out and buy a bunch of SPY. I'm simply saying the benchmark is the index, and the ETF, it tracks that. It tracks with it, right? And he told me, well, yeah, people would probably make more money. Now, that all depends on what they're in and all this kind of stuff, right? It's very specific. I'm making a general statement tonight, but this is the words that came out of this individual's mouth. And I wonder what it would be like if the whole financial industry was like that. It's just a thought. It's just a thought, you know? But news for you and I has a place. Just put it in its right place, which, as a quick recap, is it doesn't take up a ton of my time. More information is not necessarily more useful information. So cut your 15 minutes down to just 2 or 3. You want one main news item, sometimes two, but usually just one. Definitely not 10, okay? Earnings on my stock, if I'm buying or trading on a stock with the option, or I'm buying the equity itself, I'm out before earnings comes. That's a news item I don't want to mess with, because the volatility, point number 4, is the reason the trader pays attention to the news primarily. When you get into the day trading space and things like that, I may use daily news items to trigger volatility. That means I'll try to take advantage of that volatility, in news. So there are ways to take advantage of those things. That's not lost on me. But as a swing trader overall, I'm actually just using news to measure volatility, which helps me manage risk. Because when the volatility is too high, I don't want to be exposing my capital to that environment, right? It's too hard to manage that risk, right? Yes, you can win big, but you can lose big. As I mentioned, the individual in the movie, sure, you go in and you make big on one, and then you give it all back on the other. And that doesn't work. That doesn't work over time. Trust me, I know because I've tried it. And that's a fact. So appreciate you guys being on here tonight. This is Market Monday. Keeping up with the headlines really is, don't try to keep up with the headlines. Cut the headlines into headline, stay out during earnings, and don't let the news sway you too much. The price is really going to help you as a trader a whole lot more than the news. And of course, if you're with us in our programs, we're posting every single day, sifting through what matters, what doesn't, because it's just something we've learned to pay attention to things that matter over time, and things that don't, we don't waste time on. If you've never taken any of our courses, you're joining tonight, somebody sent you this video, you're watching on recording. Remember, you can always send this video over to your friends. You can tag them on Facebook. Go on over to tradeway.com. Right there on the main page, you can come and join us for a virtual Step 1 event. We've got one coming up very soon. It's 2 days, Friday, Saturday. You can join us, and we will teach you in 2 days the foundation, all of the foundation for our system of approaching the markets, particularly for people who A, don't know anything about the markets, or B, you do, but you're not achieving consistency because you don't have a system that keeps you disciplined. That course is for you. It'll be taught live by one of our coaches. So come on out, check that out if you haven't. We would love to have you guys. Steve, Adam, everybody on here, appreciate you all for being here. Thank you so much to you guys watching on recording. I appreciate you guys as well. And we will be back as always next week. Tomorrow, Tip Tuesday, trading tips right here on Tradeway TV. So come on back and we'll see you then. Good night, guys.